What's up, Greg? I'll see you tomorrow. Hey, Michael. Michael, you put out a tweet in on October 1st, and it's something that I have been saying for a while, and it relates to I think it relates to new participants coming into Bitcoin, essentially, right? So your tweet was about wash sale rules, and I've been saying that I think that the wash sale. I'll read the tweet for people because I can't nest it up there. You wrote, if wash rules are applied to digital assets, selling and volatility will dramatically decrease. I've been saying this all year because I think what I think happens is new participants that come into Bitcoin. And by the way, your comments about it being a technology, I think are 100% right. I am a technology founder in my previous life and now an investor. And I do view it as a technology as well. So that is really a great way to put it. And I don't think new people view it that way, because when I got into it in 2016, I viewed it, as you said, as a trade, right? And I viewed it that way because I learned about Bitcoin probably in 2012 or so and missed it for a while. And I was just telling this to Greg recently, and I was like, he says a good trader is someone that realizes they made an error and gets new information and changes their mind, right? And so that's what I did. And then I learned over time, once I had money in it and I started to research it more and more and more, what it really is, right? And so you really start to expand over time, but you got to be in the asset to understand it. And what I find is that people that get into it and they see this massive volatility, they get shaken out if they have too large of a position initially, right? And I think that the absence of the wash sale rules applying to it, I think heightens the volatility. And I just wanted you to expand on that thought because you put that tweet out there. And it's something I've been saying for a while, Michael. And I just think that I think what happens is, people see this thing drop down. If they buy it at, traders, right? They buy it high, they sell it, they take that as an asset, that loss, against other gains in their portfolio. And they may even, in fact, start to drive it down by shorting it, right? Like they're trying to exasperate this. And I think if they just applied the wash sale rules to Bitcoin as they do for stocks, maybe we could eliminate that. But I'm just curious what you have.
Yeah. So I think the big point here is, if you're a Bitcoiner, you shouldn't be fearful of the regulatory environment that's evolving. I think that, sometimes in our community we think, well, all regulation is bad and we don't want them involved. But the truth is, if we normalize a certain set of regulations around Bitcoin, it's actually going to be great for Bitcoin. It's going to make the asset class grow by an order of magnitude or 2 orders of magnitude. It's going to eliminate the volatility. It's going to improve the stability, and it's probably going to accelerate the transition from all the other cryptos into Bitcoin. Because here's where the volatility comes from, in my opinion. One, we're conjoined with the other crypto markets. So someone's trading at 100-to-1 leverage, Shiba Doggy coin, and they cross-collateralize it with another dog coin, and then they trade that 20-to-1 leverage, and they do it on a Saturday night in a thinly liquid market. And then eventually they tie it back into Bitcoin. So Bitcoin is getting the volatility, it's getting the ripples from highly leveraged altcoins on exchanges, and in a regulated environment, you could never trade 20-to-1 leverage. If the max is 2-to-1 leverage in most normal equity houses. So the 20-to-1 leverage or the 100-to-1 leverage cross collateralized, against 6 different coins. And if I have $1 billion coin and there's only 100 million, or if I had a $1 billion coin, 100 million in the float, and I put $1 million down and I levered it up 20-to-1, I can move that thing all around. So the first thing that's happening is there's a lot of ripples coming through the crypto ecosystem, and eventually Bitcoin is the reserve asset and it hits Bitcoin. So the second observation is if Bitcoin gets hammered and you hammer it down $5,000, then if that was a S&P index, or if that was Apple stock and you were hammered down that much, every investor would stare at it and say, am I long Apple? Yes. I'm not going to sell, because if I sell it, I might have to buy it back at a higher price. It could move away from me. So 95% or 98% of investors that are long a security won't sell it when it trades down due to random volatility. With Bitcoin, you get two really awful volatility drivers. First of all, nobody's cross collateralizing 16 yo-yo coins against Apple stock on Saturday night with thin liquidity and 100x leverage, right? That's not happening, right? You've got the thin liquidity on Saturday night. You've got the cross collateralized 100x leverage. So that's the first thing. And the second thing is, when the price gets knocked down, I can sell it, take the loss, purchase it back again, and ride it up again. So I'm actually harvesting the tax loss. And this is completely legal. It's not even a loophole. It's actually a result of, in my opinion, probably an error many years ago, because they don't apply wash rules to property, but every other property in the history of the human race was non-fungible. So if you sold your house at a loss, you could immediately buy another house. Okay, that makes sense because they're non-comparable things. They're both property, but they're different. Bitcoin is the first example where you sell a Bitcoin at 40,000 and buy a Bitcoin at 40,000, and you got the same exact thing, but the tax treatment is much better. Now, why does it cause volatility? Because if I'm a hedge fund, I'm actually encouraged. There's an economic incentive to drive the price down, to sell it, to short it down further, and to buy it back. And so that would make no sense. You couldn't do it with a security. You couldn't do it. But with a property that looks fungible, you can do it. And the result is you've just got an unregulated, highly levered market that will tend to be volatile. And you've got a tax code that encourages people. It pretty much encourages every rational hedge fund to sell whenever the price moves down 10%, or at least whenever it moves materially away from where you bought it, you should sell it and buy it back. But if you were going to sell $1 billion of it, could you imagine if I hit the market and I sold $1 billion? I could probably drive the price down and then turn around and buy back $1 billion. Now, I don't do it because of the moral hazard and the optics. I would never want to have a reputation for having done that. But if I was in a dark pool and I was just an offshore investor, or a hedge fund, I might just think I'm doing the right thing for my limited partners by capturing $1 billion loss, and it's actually, right, harvesting volatility as a tax.
That loss is an asset for them, right? That's what I keep trying to tell my friends that are in Bitcoin.
Yeah,
use that as an asset.
I think that Congress may fix this. By the way, there's chatter in the House Ways and Means Committee, and the knee-jerk reaction to a Bitcoin maxi is, I hate any politician even meddling. But the truth is, if they did establish Bitcoin pari passu, and they made the tax treatment similar to owning an index fund or like the S&P index, it would probably decrease the volatility, increase the confidence, and you might have hundreds of billions of dollars of capital flow into the market, and it would increase the price dramatically because people aren't afraid of it. Because at this point, we're down, there are only two knocks on Bitcoin. The first knock is, I think the government's going to regulate it. And now people are over that and they realize that they're not banning it. Bitcoin's around forever. And so that's the first kind of ignorant, fearful comment from an institution. And the second fear is, it's too volatile. It's volatile, right? And if we have a situation where it's treated like an index, I mean, Bitcoin is destined to be the monetary index of the 21st century and beyond. Instead of S&P being the index, Bitcoin should be the index. If it's just treated like that, then I think it's possible, when you think about it really hard, that the trading of it could decrease by a factor of 10.
Guys, the interesting thing, it's Voss, is that having worked at a hedge fund for 15 years, hedge funds get knocked for being some of these vicious people in the market. Let's understand that by far by far the largest pools of capital in the world are long-only investors. And long-only investors like a degree of regulation. It's a safety net for them. It's the asset allocators and the theory of agents in the long-only funds that love a degree of regulation. So a hedge fund, it sounds sexy for you to lay out this trading strategy for a hedge fund. And shorting and then driving markets around. When the big money gets involved, the hedge funds cannot short enough if CalPERS or CPPIB is on the other side and has an open order to buy $10 billion of Bitcoin because that's what they need to get a 1% portfolio allocation. When the big boys get involved, the big boys are not hedge funds. The big boys are the trillion-dollar asset allocators that are coming, kicking and screaming because they think they've missed it so far. They're going to come, like Michael says, when regulation makes it attractive for them to get into this market. So like it or not, they're coming. And like it or not, it's not the hedge funds that matter. It's the long-only capital allocators. So, Jay, I look forward to seeing you tomorrow night. Great questions. And Michael, once again, you nailed it. You don't do it, and nor why would you do it, because you're a long-only allocator in the Bitcoin square. I don't think there's that many hedge funds that play that game. If you are, you're playing by picking up nickels in front of a steamroller. Who in their right mind is short the most perfect long volatility trade ever created? You don't short something at 60,000 and try and make $5,000 on the downside when you know it can go to 2 million bucks and gap up by $40,000.
But Greg, wait, let me just jump in, Greg. I think so earlier in the year when we hit 64,000, and then the technical analysis indicated that there was a breakdown in the technicals, right, and it was starting to pull back. I think to what Michael might be saying is that if they were buying in on the way up, because traders are momentum buyers, right? So they won't buy the bottom when they see it and then capitulate the other way. As it starts to go back up, when it hit the 29,000, it starts to go the other way. They start to buy, you know that, right? So they'll buy on the way up. So they were buying on the way up, some of these funds. And then when it went the other way, they're quick to take the loss because it's like, okay, I bought it at 60 or I bought it at 55 and it's going below. Okay, I'll capture that loss. That's an asset against the other trading that I had for gains, right? So they can capture it because they can't do that in the stock market, right? Because of the wash sale rules. So they're able to do that. They can take that. And then I guess to his point is, you're right. It's absolutely insane, right? It's insane to short Bitcoin. But if you see that it's moving in a certain direction, it's just momentum. Let it try to exasperate it on the way down to further drive the positions that you do have,
Well,
and maybe get more losses.
Yeah,
Yeah.
we don't have a lot of time here because I think we're almost out, and this is an interesting subject we could spend half an hour on. Just to be clear on my point, Greg, they're not short. They're simply selling $100 million and immediately buying the $100 million back and capturing the tax gain. And you can do that if there's no wash trading rule. But
Yeah.
if they implement the wash trading rule, there'd be $200 million of trading that would just disappear.
I hear
That's
you,
the
guys.
point.
And here's the exciting thing. Yes, there's short term. So bulls, bears, and pigs, right? Liquidity comes from all different angles. My big thing is, and I've dealt with these funds in my life, it's really exciting when you have a pocket order from a huge account like Capri, and I'm just throwing that name out, somebody in high yield who dominates high yield, and by the way, is a very large equity holder in your company, Michael. Your MicroStrategy stock, Capital Research out of Los Angeles, is run by a friend of mine who I used to trade with. Okay, full stop. When he gives you a pocket order to buy 10, 50 million or 100 million versus bonds, and you don't tell the world, and all of a sudden you have that in your pocket, and you're like, short it to me, hedgies. I think it's a good trade. If you think it's going down, I have the bid. And guess who wins that game every single day? The Caprees of the world, not the hedge funds that are too smart by a half. So I'm really excited about all the different players in the market. My final suggestion is, though, at $60,000, Bitcoin is a rounding error. If you're too fancy and think you're a good trader, they're going to cart you off the floor. Put your portfolio in Bitcoin and the other X% in these other stupid assets that you think you can trade, and don't outsmart yourself in the Bitcoin world. That's my advice. And, you know, seen it, done it. Bitcoin is not a trading vehicle. Bitcoin is insurance, and you don't trade your fire insurance.